Hello everybody, this is the results presentation for Impax Asset Management Group, which is an AIM stock, ticker IPX. We've split the presentation into a number of sections, the first of which is a general introduction to the firm, so I'll go through that, and then secondly the business highlights, and then hand over to Charlie for the financial summary. So, Impax Asset Management is a 18-year-old firm. We are one of the leading investment managers specialising in the resource efficiency and environmental space, and as we'll explain, that is a particularly attractive area of investment for investors who are looking for superior growth. We have investments in three asset classes: listed equities, private equity and property, and our aim is to scale up those strategies and grow our assets under management in order to deliver a scaled business and through that significant shareholder value. This slide shows the history of the firm in assets under management as measured at the end of each of our financial years, and our financial year ends the 30th of September. So you can see we came from very small beginnings but have been growing very nicely over a very long period of time, and what's most notable about this slide is just the very strong growth of assets under management over the last 12 months. Obviously we'd like to explain what's happened there and also set out our views of what should happen over the next 12 months and beyond. So many will have heard that asset management is under pressure, that investors, asset owners are worried about fees, worried about the value of the service that they're getting. We would not dispute that, and there's definitely a case for investors looking at passive solutions, ETFs, etc., as a way of getting fees down in the core of their portfolio. But in a world of sluggish economic growth prospects, then there's definitely a opportunity for specialist investment managers with strategies that are set to deliver outperformance, all being well, if they're properly executed. The scope for those investment managers to secure mandates. And so the world is splitting in asset management terms between the shift to passive on the one hand, but also the demand, rapidly growing demand for active investment management, and that's where Impax fits very well in that second space. The environmental markets, the resource efficiency areas that we cover are shown on this slide. So this is a classification that FTSE's been using now since we introduced it to them in 2007. Essentially, in a world of rising populations and rising standards of living, and the pressure on resources, both natural resources and environmental resources, the backdrop there is one of increasing demand for goods and services that can address those problems in four areas: alternative energy, water supply and treatment, waste management and materials, and finally food and agriculture. So the industries in those four categories are where Impax dedicates its work to, and as you'll see, those are particularly interesting for specialist investment management. This next slide gives a bit of the background to that claim. First of all, on the left you can see the rapid growth of investment opportunities in environmental markets. These are companies that have got at least 50% of their business from environmental markets, goods and services. So there's now 1,100 quoted stocks. They tend to be mispriced, or there's a prevalence for mispricing that comes from the fact that they are complex. There's lots of technology change, there's lots of regulatory developments, there's a lot of corporate M&A, and that means that that average investors quite often misunderstand what's going on, and gives a specialist group like ourselves an opportunity to identify undervalued stocks. And on the right you can see that for companies in our core portfolios there's typically a lower level of sell side coverage, which is another indicator of opportunity to add value. Here's the most recent growth of our assets under management between the end of financial year 15 and the end of financial year 16. So we've reported £4.5 billion under management at the end of September 2016. By the end of November 2016, so just 2 months later, we put on our website that AUM had grown to £4.9 billion. So we've had a very good start to fiscal year 2017. On the right of that pie chart, you can see that at the end of September, listed equities was the most significant part of our AUM, with the other two asset classes being smaller. But just a few days ago, on 30th of November, we announced that we'd reached first close of our third renewable energy infrastructure, or private equity as we call it, fund, at 149 million euros, and that's in addition to the money that you can see there. The next slide is our shop window. So on the left you can see the 6 investment strategies that we run for listed equities. In the top box, those are the 3 that we've been running for quite a considerable period of time and are at a significant scale. The lower box, starting with food and agriculture, are in development, but certainly in the case of food and agriculture, raising assets very rapidly. On the right-hand side, the real assets in light green, the 2 renewable energy infrastructure funds in our private equity division, and in the grey, our property business. And intriguingly on this slide, at the bottom right, you can see the capacity of the listed equity strategies, which we estimate today to be £10 billion. So that gives us scope to more than double the size of today's business without introducing any new strategies. For a specialist investment manager in a complex area, investment management skill is obviously the heart of the offering, and we think of ourselves as investment management led, but then that poses a challenge as to how we reach our client base. And for the last 18 years or so, we've been very carefully building up our connections and relationships around the world, either with direct sales forces, which we now have in the UK and in North America, or through third-party relationships, which extend now around the world, particularly in continental Europe and Asia through BNP Paribas investment partners. But also we have country-specific investment partners in, or distribution partners in Japan, in the Netherlands, in Canada, and in the United States. So this quite complex array of relationships allows us to find institutional and private client investment distributors or distribution partners in lots of different markets around the world. Another interesting and important factor for Impax is our ownership structure. So today all the shares are equally classified, so there's just one class of shares. They're all quoted on AIM, as I said at the outset. 25% of the shares are owned by BNP Paribas investment partners, who bought those shares on the secondary market in 2007 and for whom we've been providing investment management services since 2006. Management owns 38%, and then the balance is free float. Moving on to the update for FY16. So some of these points I've already mentioned, but we've had our strongest ever year in absolute growth terms, with nearly £500 million of new money. The close of our 3rd private equity infrastructure fund in November, so post year end, is a very important milestone in the further growth of the business. We've had excellent investment performance continue, and we've had some very interesting distribution developments, particularly in North America. Here are the financial headlines. Charlie will give you a more detailed rundown, but alongside the growth in the AUM, we've had an increase in revenue. The revenue increase is not as much as the AUM growth because of the lag effect, in particular, the effect of the timing of when the flows have come, plus a slight change in the mix of the business. The earnings have grown considerably, as has the dividend, both in the final year dividend and the full year composite dividend. Prospects for the investment sector that we're in, environmental markets and resource efficiency, remain extremely strong. There is very strong momentum worldwide in improving the resilience of water infrastructure, waste management facilities in the wake of increased urbanisation. With energy prices now rising again from historical lows, then there is increasing scope for energy efficiency businesses. There's plenty of momentum behind climate change policy, particularly in China and the European Union, and that's driving renewable energy investments. And then across the food and agriculture value chain, then there's plenty of secular growth coming from improvements in efficiency with which food is moved around. A couple of quick comments on the 2 of the main topics for generalists in 2016. The European Union referendum in the UK is having minimal impact on us. In fact, in the short term, it's actually quite positive. So as you'll see in a moment, we have a significant majority of our client base outside the UK. In addition, a very small percentage of our assets are actually invested in the UK. So we have quite limited exposure to the UK economy. And with regard to the US election, then the statements from the Trump administration to be are so far broadly positive. So we are quite exposed to infrastructure investment to industrial growth with the efficiency and clean-up opportunities that typically brings. So that's giving us quite a lot of optimism around certain of our markets in the US. Areas to be cautious about include renewable energy in particular. So we're keeping a close eye on the new administration appointments, particularly with the Environmental Protection Administration and the future of certain specific legislation. But because we're active investment managers, we can move our money around if we find particular stocks or private companies that are likely to be impacted by market-specific events. And meanwhile, there's plenty of momentum worldwide for tightening up the response to climate change. So post the Paris Agreement in December 2016, the recent Marrakesh Conference of the Parties reaffirmed global commitment to reduce greenhouse gas emissions, and that should lead to continued march forward of rapid growth for renewable energy and energy efficiency investment. This next slide shows the breakdown of our client base. The dark green bar, the position at the end of September 2016 compared to 12 months earlier in the light green. So you can see the largest absolute increase, as I mentioned, was in the European and Middle Eastern area region, with North America actually growing by the largest percentage from a smaller base. And that North American breakdown is shown in the next slide. So the composite slide at the top shows growth both in our mutual fund sub-advisory mandate that we have with a group called Pax World. With regard to the Impax label, the commingle fund, which is set up for tax-paying domestic investors, with a couple of segregated accounts that we brought in from US pension funds, and finally with 2 Canadian distributors who we managed to land in the first half of the year. So that really is a very strong directional indicator, I think, of the success of 10 years of investment that we've made judiciously in the US. We've had a team on the ground for 5 years. We now have 6 people covering both East Coast and West Coast from 2 separate offices. And we're very optimistic about growth opportunities for raising money from US and Canadian investors in the future. In our listed equity business, we had a strong year. We've further extended our investment track record. We've been able to grow the food and agriculture strategy that we initiated in 2012, particularly through a new relationship as of 2015 with BNP Paribas, who've now raised £162 million for the so-called Smart Food Fund. That's grown to in excess of £250 million by the end of November, with the launch of a parallel strategy which concluded in November. So that's a post-year-end result that's captured in that overall AUM of 4.9 billion that I mentioned. This next slide shows the cumulative investment performance in percentage terms to the end of September 2016. That's in our 3 core listed equity strategies on the left, so specialists, leaders and water. And that's compared to the All Country World Index, which is a generic global equity benchmark on the right. So I think those numbers speak for themselves, but we've got a very good investment track record, which is underpinning a strong pitch to potential new clients. And this next slide on the left shows the breakdown of the assets under management growth between outflows, inflows and market movement in each of the first half of the year and the second half. So I think those numbers speak for themselves, show you the strong increase in inflows, so net inflows of £496 million, which is total inflows minus outflows. And on the right, the revenue margin was down very slightly. As I mentioned earlier, the business mix has shifted slightly over the 12 months prior to the launch of our private equity fund, and that revenue margin average allows you to do back of the envelope calculations as to what our run rate is. And in the real asset space, then, we've had very good track record with our renewable energy infrastructure fund, with significant exits from our second fund, which has underpinned the investment case for Fund 3. And then in sustainable property, which was a business that we brought on board in middle of 2014, we are working on the finalisation of the exit from the first fund, which the team had raised prior to joining Impax. And once that's concluded, then we would be looking to raise additional capital to form a second fund.
Great, good afternoon everybody. I'm now going to take you through the financial performance, and starting with slide 25, which is a quick view of the P&L, the operating performance of the business. We're really pleased with these results, both looking backwards, but in particular what this means on a go-forward basis. So on the left we can see the revenue. This is up year on year. The reason it's up is because of the increase in assets under management. The listed equity business has seen these strong inflows and market movements that Ian's referred to, which has contributed to the increase. And that's offset by reduction in fees from the private equity business as our old funds gradually winds down. I'm stressing that this is actually a good effect. It's an expected effect as these funds come to the end of their life, to be then replaced by the subsequent fund, the third private equity fund that is already earning us income. The run rate for end of September was 23.7 million, and you can see that's already quite a bit above the September 12-month prior period, reflecting the fact that a lot of these inflows occurred in the second half of the year, so we have a full year annualisation effect increasing the run rate. The new private equity fund and the inflows we've seen in the last 2 months means that that's already out of date, and we're looking at a number over 25 million, probably more like 26 million. The operating costs in the middle, we're basically a people business, so the majority of those reflect staff, and it's a very stable picture as you can see. During this period we've hired 3 people at the middle and junior levels, and the fixed costs, the non-staff costs are very stable as well. I think looking forwards we can expect a small increase to those costs. We do need to move buildings over the next year. Don't expect it'll have that large an effect, but it will edge upwards, and we can also expect to see staff continuing to grow slowly in line with the business. When you put the two together you get the operating profit on the right, and you can see here the strong operational gearing effect feeding through. The revenue increase is leading to an increase in operating earnings from 3.1 up to 4.2. And when you look at that in percentage terms, the margin has improved from 16% last year to 20% this year, and on a run rate basis already at 23%, so going clearly very strongly in the right direction. The next slide is a bit more colour on this operational gearing I'm referring to. It charts the change over the last 5 years. On the top left you can see the assets under management, which as Ian's already said has grown significantly over that time period. However, the number of staff we've required to service this business, which is shown on the top right, has only increased by 44%, a much lower percentage. And this is also over a period where we've been building the capability, the US distributions Ian's talked about, and a couple of new products within the business, the listed equity business and the real asset business. We now believe that number of employees is broadly stable and will grow with increasing business rather than needing to grow standalone. The other good thing that is shown on this slide is on the bottom left, where we can see that the cost per employee is going downwards. This reflects the type of individuals that we're hiring, which is very much at the middle and junior level. And finally on the right we can again see the fixed cost, non-staff costs staying pretty stable over that period. So moving on, what this means for earnings. I wish the left graph was drawn accurately to scale, but it's not quite as dramatic as shown there. The increase in earnings that is due entirely to the operating result of the business feeds straight through into the earnings per share. Last year had a couple of one-off events, so the increase is even bigger if you compare it on a like-for-like basis, but 3.62 is now the earnings per share on a looking backwards basis. On the right we can see what this means for dividends, and we have a progressive policy. We've increased the final dividend and indeed the interim dividend every year since inception. And on the back of this very strong result, both the period to September 16 but also the prospects for the future, the board's announced a 31% rise for 2016 to a 2.1 pence dividend. At this level the dividend is 1.8 times covered, and the board's view of that is that there's still a scope to review the policy for over the coming year, and we intend to make some announcement next summer as to what the policy will be going forwards, but there's definite scope to increase the payout even further as we proceed with the increase in profitability. Moving on now to the balance sheet. This is a very straightforward balance sheet. We have basically investments in our own funds, which I'll explain, cash reserves and no debt. The investments are shown on the left. These are made as part of the business, running of the business, where we seed new funds. So this is putting money into our own products to establish a track record or to open up a new market. We currently hold 3 of those such funds. And on our private equity business we invest alongside our investors, for the life of the business, or the life of the funds, and those two together comprise the 11 million of investments. We should also note that the new private equity fund, the third fund we just announced, we've committed 4 million euros to that fund, which will be drawn down in stages over the next few years as the fund spends its money on new investments. The middle column is the cash reserves. So the business is strongly cash generative. The operating earnings pretty much fall through to the bottom line and boost cash on a year-by-year basis. One of the main reasons cash is down actually compared to the last year is we have a buyback program to buy Impax shares, which I'll comment more on in a moment. But 3.6 million were bought during that period at 42.6, that should say pence per share. In terms of the size of the balance sheet, there's 15 million of cash, as I just referred to. If we haircut that by maybe 5 million to reflect that we are an investment management business and need to maintain a risk buffer, then that's 10 million of cash and 11 million of investments that we describe as available, or something like 19 pence per share of value sitting on the balance sheet in those forms. On the right, I set out how we're managing the shares in issue. As Ian said, there are 127 million ordinary shares. There's a buyback program, and the reason that buyback program exists is to mitigate the effect of equity awards that are made to staff. So over the last couple of years, we've been issuing RSS awards, restricted share awards. The cost of these awards is paid for from the staff bonus pool, so there is no net cost to the shareholder for those shares, and the dilution is being managed by the buybacks. So what we can see in the diagram is the total buybacks to date and the RSS awards that have been made, and in addition there are 12.9 million of options available outstanding for staff, which are also being covered by the buybacks to date. So finally, commenting further on stakeholder alignment, Ian's already mentioned the large holding of the nice split between the shareholders, be it BNP, 38% of staff, and the free float. In terms of the staff stakeholders, that incentivisation is important, as is the remuneration. And here we set out the policy, which is to pay median salaries and to have a profit-related bonus. So the profit-related bonus is determined looking at the operating earnings and typically capping it at 45% of earnings before the bonus number. That way there is clarity for the investors as to how much of the profitability is going to the staff and how much is being retained for the shareholders. The restricted shares, a bit more information here. These are a 5-year scheme that vest over 5 years for staff, and the cost of these comes from the bonus pools, as I said before.
So just to conclude, what we've hoped to have conveyed is our excitement about the prospects for Impax in a world in which demand for investment management services is changing. There is a rapid expansion of opportunities for those specialist investment managers that have got a differentiated offering. And our experience over nearly 2 decades of running Impax is that the environmental markets and resource efficiency sector is very well positioned for superior growth, for sustained complexity, and therefore is a very natural hunting ground for a specialist investment management team. With 30 investment professionals located on 3 continents, we've got one of the largest, most experienced investment offering out there anywhere in the world, and so we are regularly sought out by pension funds, insurance companies, sovereign wealth funds and private banks for services in this space. I think our recent track record of growth suggests that there is a lot of demand building for the services that we provide, and we've been paying particular attention to both increasing shareholder value and also the alignment of interests. Looking ahead, with the prospects for economic growth being somewhat sluggish, but in certain areas around industry in the US, infrastructure investments, climate change mitigation, and also the Chinese policy to cope with more and more people moving to cities, then there's plenty of reasons to be optimistic about the potential for growth of earnings and shareholder value across the environmental space. And in that context, Impax is very well positioned.
Great, thank you very much, gentlemen. And I'm delighted to say lots of questions, so let's dive straight in. Firstly, probably one for you, Ian. Ashraf had not heard of Impax until you gave a very useful introduction a couple of weeks ago. Going back in time, could you outline whether you and the other founders were driven by ethical and environmental considerations, or were you just very shrewd businessmen who identified a long-term growth area?
Yes, thanks. It's a great question. I didn't actually mention the fact that we are not ethical investors per se. We're not trying to save the world. We are trying to make money for our clients and ultimately for our shareholders. The reason that we're in this space and not in other spaces is really due to the personal interest of myself and the people that joined Impax in the early years. We're just fascinated by what makes these sort of companies tick, and we've been very happy to dedicate our careers to looking at this space.
Thank you. A question from Declan. Your growth story appears to be a very organic one, a scalable proposition and a controllable cost base. But are there other firms or indeed teams of other people such as asset managers or indeed on the distribution side that you might look to buy to accelerate this growth?
I think one of the key features of success in investment management is the confidence of your current clients and their advisors, and there's a very strong undercurrent of advice not to grow an institutional investment management business by aggressive acquisition, shall we say. So we're very happy with a core business plan based on organic growth because we do have scalable strategies. We can more than double the size of the business without any sort of acquisition. Having said that, we've got a couple of examples in the recent history of successfully bringing on board additional capabilities. So in 2012, we hired 2 people who'd got experience of running a food and agriculture team. They came at no cost to the firm except their salaries from day one, and we've now been able to grow a successful strategy in that area. And secondly, in 2014, as I mentioned, we brought on board the property business, which was the remains of the first fund plus the 2 investment management professionals who've been running it. There was a small retrocession to be paid on the management fee as a consideration for that acquisition, but it didn't otherwise cost the shareholders of Impax anything. So I think core organic growth is what we're about, but we're not averse to looking around for teams if they can really add something which is complementary without disrupting our core offering.
Okay, all right, a couple of questions on the private equity fund. Perhaps Charlie, the first one from Lynn. Could you just clarify how long it took to reach the first round closure, and also give an idea of optimal size for a fund like this, given that you do get paid for managing the money, but presumably there is a scale where the assets might become too unwieldy to deploy in your investment style?
Yeah, sure. So the sequence of raising private equity funds is quite well controlled by the investors. They want to see a good level of exits from the current funds, and they want to see that the market is ripe and attractive for a new fund. So we've been selling assets from our second fund since middle of 2015, but with a real acceleration in the first half of 2016. So that's really dictated the timing of the closing, the first close, if you like, of the new third fund. As is normal in these sorts of businesses, we'll be carrying on raising money for that new fund until we've reached a sensible limit, which is hopefully going to be quite a lot more money than we've got, 149 million that we've got so far. We would anticipate that fundraising carrying on until the end of 2017, maybe into early 2018. We've definitely set ourselves a capacity limit, so we're not actually disclosing the maximum size of the fund, but we're very conscious of the need to keep it at a manageable level to avoid getting dragged down by the weight of too much money. So the investment process has already started for that fund. We've already had our first investment committees, and we're very confident of raising more money.
Okay, and a natural follow-on from that comes from Mike. You identified quite strong investor demand in certain areas. Does that mean you're likely to expand your portfolio of product offerings any further, or is it, in your view, comprehensive at the moment and you can just build the assets within the defined segments?
So the core plan really is to grow what we've got at the moment. One thing that I didn't bring out is the bottom strategy in the list of 6 in our what I call the shop window. That's the so-called global opportunity strategy. That is a global equity strategy that goes slightly beyond the environmental markets area to look at other industries, other markets that are shaped by the transition to a more sustainable economy, including, for example, financial inclusion in developing countries, education, healthcare, etc. That strategy we seeded in early 2015 with our own balance sheet money, and we are in the process of building its track record. So over the next 12 to 18 months, we would anticipate taking that out to clients and their consultants with a view to trying to raise some client money. That does have quite significant additional capacity, so that would be another lever for growth, if you like, in the future. Beyond that, the core plan is not to launch new strategies for the foreseeable future, but as I mentioned in the answer to the previous question, then we're not averse to bringing on additional teams if they can add something without disrupting what we have at the moment.
Thank you. In terms of marketing, are you likely to increase your resources for the direct marketing, and could you briefly summarise what are the margin implications for you between using external parties and your own routes to market?
So at the moment we have direct sales, as we call it, sales resource in the UK and the US, covering North America. Our plan is to selectively increase the team size with one hire at a time in each place, subject to increased confidence in the potential. So over the last 18 months we've added 2 people in our US team, for example, taking it from 4 to 6. And we've also added 1 person in the UK team, taking it up to 3 people doing direct sales. So we're very careful about not adding people ahead of real robust confidence in opportunity. In terms of margin impact, then typically we are getting between 35 and 65 basis points of net annual management fee for funds and accounts that we sell through third parties, and we are getting a little bit more than that, potentially up to 100 basis points for funds and accounts that we sell directly. So we need to trade off the increased or the higher net margin, net revenue from things we sell directly, funds we sell directly, against the cost of delivering that through increased headcount on the sales side.
Dividends, we have a question from Paul, who is encouraged to hear that you might be examining the diminution of cover as you move forward. His question is, you paid a special dividend last year, 2015, but not one this year. Could you give a little bit more background as to how you look at that from a board perspective? And then also on margins, where this year has seen a very good uptick, could you give a little more insight as your longer term 3 to 5 year views about whether margin growth can go materially further?
Great, thank you. So in terms of the general principle for the dividends, the board has not yet met to consider exactly what the policy will be going forwards, other than to indicate that there is scope to reduce the coverage level. The special dividend last year was special. It was a one-off, and it related to some specific factors that went into the P&L account in 2015. In particular, there was a settlement with HMRC around a complicated tax matter from the past that's now behind us, and that meant that we were able to release the reserve, and on the back of that we decided that it was appropriate to make a special dividend to shareholders. So that was very much a one-off effect in terms of that particular dividend. We're not expecting one-off effects in the future, but to the extent that they occur, I wouldn't rule out a further special dividend, but I don't think anybody should be expecting special dividends. The principal opportunity is to increase the profitability and increase the dividend on the back of the profitability and potentially cover. Want to comment further?
Well, there's a question about the margin. So
Yep.
Our expectation is that the margin can continue to grow as we scale up the business. We would anticipate growing our current headcount of 70 up to somewhere in the range of 80 to 95 for the next 3 to 5 years, in line with further growth of the business. So some back of envelope calculations would suggest that we ought to be able to get our operating margin up to and potentially beyond 30%. So at the moment that's the intermediate or medium term target.
And then a final question from Elizabeth, who compliments you on your focus on areas that do seem to be offering very good further growth opportunities. Could you briefly identify any competitors who might be looking at similar strategies, and also what you would see the barriers to entry for people coming newly into these areas of focus?
So competition really is in two areas. First of all, those investment managers who are offering services in the private wealth market and potentially are running up against the offerings of our distribution partners. So for example, BNP Paribas run a number of funds under the Parvest label where we provide sub-management. So those funds would sell into the private wealth, maybe even directly into the retail space through the BNP Paribas network. There the competition would come from branded investment managers such as Allianz, from Schroders, from Lombard Odier, from the other well-known brand names. Typically, however, we would not find those companies competing in the other segment that we're offering, probably the largest opportunity for us, which is the institutional space, where there is much more interest in the size of the team, the dedication of the business to in the space. And there, the sort of companies that institutions might come up against would include Generation Investment Management, which is a London-based firm, potentially Robeco Sam, which used to be called Sustainable Asset Management, which is based out of Zurich. And then there's a group called Mirova, which is based out of Paris. So they would be typically around the shortlists of an institutional mandate, along with Impax, hopefully.